Right now, there is a brand new federal rule that could put up to $720 back in your pocket per person. If you're married, that's nearly $1,500. And most seniors over 65 are going to miss it completely. Not because they don't qualify, but because nobody told them the truth about what this rule actually does. So let me tell you the truth. Sitting right here, plain and simple. I'm Artur. For more than 20 years, I've helped American retirees protect their benefits and keep the money that's rightfully theirs. And in the next little while, I'm going to show you exactly what this new rule is, who it helps, who it quietly leaves out, and the 3 simple steps you need to take to make sure you don't leave a single dollar on the table. Stay with me until step 3, because that's where I'll show you the one mistake that even people who do everything right still make. And it's costing seniors hundreds of dollars every single year. Now, you've probably seen the headlines. Seniors are now exempt from these bills. Social Security is finally tax-free. Your nephew texted you about it. Somebody at church mentioned it. Maybe you saw it on Facebook. Here's what I need you to hear, calmly. Most of those headlines are wrong, or at least they're twisted. And that confusion, that's the real danger. Because when people believe the wrong version of a rule, they make the wrong decisions with their money. Let me give you the real version, the one that comes straight from the IRS. Let me tell you about Margaret. Margaret is 68 years old. She lives in Ohio. She worked 31 years as a school office administrator. She did everything right her whole life. Paid her taxes on time, kept her records in a folder in the kitchen drawer, never missed a deadline. Margaret lives on about $38,000 a year, a little Social Security, a small pension. Comfortable, but careful. She watches every dollar. Last winter, Margaret heard the same thing you probably heard. Seniors don't have to pay taxes anymore. It's all changed for 2026. So when tax time came, Margaret figured the new rules would just happen automatically. She let her same old software fill everything in. She clicked through it the way she always had. She filed. And she left $720 sitting on the table. Because here's what Margaret didn't know. The new senior deduction, that $6,000, it doesn't apply itself by magic. There's a specific form, a specific line. And if you don't claim it, the government does not call you up and remind you. They just keep the money. $720. For Margaret, that's 2 months of groceries. That's her car insurance for half a year. Gone. Not because she didn't qualify, but because she assumed it was handled. And the most painful part? It was completely avoidable. A 5-minute fix, one form. And Margaret is not alone. Tax research groups estimate this same kind of confusion touches the vast majority of the roughly 50 million Americans over 65. The Center for Retirement Research has laid out exactly how this deduction works, and exactly how easy it is to miss. So let me make sure that never happens to you. Let's go through the facts. Slowly. The way I'd explain it to my own mother. Here's what the IRS actually says. For tax years 2025 through 2028, if you are 65 or older, you can claim an additional $6,000 deduction per person. If you're married and you're both 65 or older, that's $12,000 between the two of you. In plain English, that means the government lets you subtract another $6,000 from the income they're allowed to tax you on. It sits on top of your regular standard deduction. On top of the extra standard deduction seniors already get. This is a new separate piece, and it's stacked on top of everything you already had. And here's the good news. You get it whether you take the standard deduction or whether you itemize. You don't have to choose. The one rule, you need a valid Social Security number, and if you're married, you have to file jointly. That's it. So what should you do because of this fact? Make sure your tax return is for the year 2025 or later, and make sure that deduction actually shows up on it. We'll cover exactly how in the action plan. Now let's talk about the money. Because numbers matter at the kitchen table. The official rule is this. The $6,000 is a deduction, not a check. I want you to really hear that. Nobody is mailing you $6,000. What happens instead is your taxable income drops by $6,000 and your tax bill drops by a piece of that. In plain English, if you're in the 12% tax bracket, which is where a lot of retirees live, that $6,000 deduction saves you about $720 in actual tax. A married couple, both over 65, both in that bracket, around $1,440 saved. So when you hear 6,000, don't expect 6,000 in your hand. Expect a few hundred to over $1,000 less owed, real money. But let's be honest about the number so you're never disappointed or fooled. What should you do? Know your bracket, roughly. And know that this deduction is worth real cash to you, enough to be worth 5 minutes of your time. Now here is the part that most people, including some financial advisors, get completely wrong. This deduction is worth nothing to the poorest seniors, and nothing to the richest ones. Let me say that again because it sounds backwards. A tax break that's advertised for seniors actually skips the seniors who need it most. Here's why. A deduction only helps you if you owe taxes in the first place. If your income is already so low that you owe $0 in federal tax, and many seniors are in exactly that spot, then this deduction does nothing for you. You can't subtract from a bill that's already zero. The Congressional Research Office confirmed this in black and white. The deduction reduces your income until your tax hits zero, and after that, it just stops doing anything. And on the other end, if you make too much, it disappears too. The deduction starts shrinking once your income passes $75,000 if you're single, or $150,000 if you're married. Past a certain point, it's gone entirely. So who actually gets the most out of it? The folks in the middle. Middle-income retirees. Which means two things for you. First, if you're a middle-income senior, this is genuinely your money. Go get it. Second, if your income is very low and you owe nothing, please don't fall for anyone telling you this rule changes your life. It may not change anything for you, and that's okay to know. And let me clear up the biggest myth of all, because it's everywhere. The official truth is this: Social Security benefits are still subject to federal income tax. The same rules as before. This new deduction did not make Social Security tax-free. It did not abolish taxes for seniors. It did not exempt you from any bills. In plain English, yes, because of this deduction, most seniors, estimates say around 88%, will end up owing no tax on their benefits. That's a real and good thing, but the tax itself was never repealed. Higher income seniors still pay it. So if anyone tells you seniors don't pay taxes anymore, you now know better than they do. What should you do? Don't change your behavior based on a myth. Don't skip filing because you heard it's all tax-free now. File correctly, claim what's yours, and let the real rule do the work. All right, here's where it all becomes action. 3 steps, just 3, because 3 is what we remember. Step 1, confirm your age and income. Write it down on a piece of paper right now. Are you 65 or older by the end of the tax year? Is your income under $75,000 single or $150,000 married? If yes to both, this deduction is yours. This takes about 2 minutes and it costs nothing. Step 2, claim it on the right form. The deduction goes on. Schedule 1A of your Form 1040, or use Form 1040 SR, the larger, easier version made specifically for seniors. If you use tax software, look for the senior deduction and make sure it's checked. If someone prepares your taxes, ask them directly, "Did you claim my Enhanced Senior Deduction on Schedule 1A? Make them answer. This is the step Margaret missed. Step 3. This is the one most people skip. Get free expert help and double-check past returns. You do not need to pay anyone for this. Call the IRS Free Tax Program, VITA, at 800-906-9887, or call AARP Foundation Tax Aid at 888-227-7669. They prepare senior returns for free. And here's the part that matters. If you already filed and forgot the deduction, you can fix it. You file an amended return, Form 1040X, and you can go back generally up to 3 years to claim money you missed. If you skip this step, that money is simply gone. The IRS keeps it. Don't let them. Before you go, do me one small favor. Drop a comment below and tell me, did you already know about this deduction? Just type yes or no. I read every comment and I reply to as many as I can. And if you have a parent, a brother or sister, a neighbor, or a friend who's on Social Security or Medicare, please share this video with them right now. It could put hundreds of dollars back in their pocket. That share button is right below this video. If you're not subscribed to Senior Pension Benefits Hub yet, hit that subscribe button and turn on the notification bell. I post new videos every Tuesday and Friday, breaking down exactly these kinds of rules, because they change constantly, and you deserve to hear the truth, not the headlines. And in my next video, I'm covering the IRMAA surcharge, a hidden Medicare charge that can add hundreds of dollars to your premium, sometimes over $600 a month, and the one form that lets you appeal it and get it lowered. Millions of seniors are paying it and don't even know they can fight it. Click right here to watch that one next. I'll see you there.